welcome to this month's Financial Markets Update. Well, it was a little bit of a mixed bag for financial markets over the course of August. We saw equity markets struggling after what's been a reasonably solid period for equities over the last quarter or so. They came back, particularly the more cyclical parts of the market through emerging markets and global small caps. But as I said, if we look over the quarter, those parts of the market have been up solidly. So again, the pullback that we saw really was on the back of just comments coming out of the US, along with challenges in China and just the growth outlook for China that we've spoken about previously. But comments from the Fed indicating that, whilst the US economy is starting to show signs of cooling, it's probably not at the speed of which the Fed would like. And in the context of that, the potential for further interest rate rises is still very much in play. As we've spoken about previously, we still believe that the overall growth outlook for the US economy particularly remains sound, and we're not expecting, as I said, or certainly not envisaging that the economy is going to move into a recessionary environment through the back end of this calendar year into 2024. But notwithstanding that, as I said, interest rates, inflationary outlook continues to drive a lot of what we're seeing in financial markets. And whilst obviously our local market was lower, we only had really consumer discretionaries, and the REIT sector were the only parts of our local market that were higher. Global equities were able to eke out a slightly positive return on an Aussie dollar basis, and this was on the back of quite a reasonable sell-off in the Aussie dollar, which was down around about 3.5% over the course of August. So in the context of that backdrop, unsurprisingly, as I said, it was by and large a pretty challenging month. REITs, interestingly, again, we saw a divergent performance between domestic and global REITs. Aussie REITs were up a bit over 2% over the course of the month, so a solid investment performance, and that continues on a rebound that we've seen in the sector over the last 3 to 6 months, and a lot of that, in our view, has on the back of potentially interest rates starting to peak, and we've seen bond yields sort of remain relatively constrained over the last couple of months. We're not even seeing a sort of a breakout move in bond yields, so valuations in that part of the market continue to look relatively attractive. So month-on-month volatility in the REIT market remains high. For G-REITs, again, the big impact was, as I said, the weakness in the Aussie dollar. So that component part flowing through impacted both hedge global equities as well as REITs. And for bonds, it was relatively flat, benign market. We didn't see a significant move in bond yields over the course of the month, and that's translated into performance that's slightly positive from an Aussie perspective, whilst global markets were lower over the course of the month. When we think about the broader outlook from an investments perspective, and really, from our point of view, looking at sort of what's driving financial markets, it continues to be the US economy. It does, in our view, remain sound, and there's a number of data points that we saw throughout the course of August. It really points to the underlying strength of the economy. Yes, it is starting to moderate. There's no doubt about that in terms of the growth outlook, and we expect that to continue as we head into the back end of the year. And from our point of view, we take the view that the Fed policy is working. Higher interest rates are starting to bite in parts. But, when you're looking at the overall strength of the economy and just looking at a number of these charts here, you can see that the service sector is still remaining robust. The overall growth is still there when thinking about that side of it. Payrolls continue to beat estimates across the board. And again, we've seen that, just in the context of the participation rate. So people are keen and wanting to look for work are able to find it. So in the context of that side of things, we continue to see a pretty positive outlook in regards to growth. Retail sales, by and large, also remain relatively strong. And the housing market, albeit having come off a low base, still looks to be in growth territory, slightly moderation over the last couple of months. And again, we think that that's on the back of what we're seeing in regards to Fed rates starting to really take hold across the economy more broadly. And then obviously the inflationary side of things is pointing in the right direction in regards to moving lower. And certainly, as I said, we expect that to continue to moderate. From a Fed perspective, they'd probably like to see it at a quicker rate. So in the context of that outlook, as I said, we wouldn't be surprised and certainly envisage that we've probably got one further rate rise in in the US coming down the pipeline through the latter stages of this year, and then in our view the Fed will be on hold. So that'll sort of see the Fed funds rate at the top end at about 5.75%. So still well north of what we're seeing here domestically, and it's one of the reasons why the Aussie dollar continues to be challenged, along with other major currencies, Japanese yen, Chinese renminbi is an example in the context of moves against the US dollar. So we continue to be underweight our $8 exposure across our portfolios on the back of that. And just finally, when we're thinking about sort of what are we seeing in regards to other parts of the global economy, and how we're thinking about portfolio positioning, and these charts here, City Economic Surprise Index. So anything that's above the line is basically beating forecast estimates. Anything below the line is sort of showing that the data was below forecast estimates. And you can see here that on a global basis, we're sort of roughly slightly above in the positive expansionary territory. So the data coming out on a global basis is very much, as I said, leading to some improvement in the growth outlook from what we've seen through the back end of last year. Clearly, that's been driven by the strength in the US economy. You can see there that that's really truly in the positive territory compared to other regions. China, unfortunately, as we've spoken about that previously, is really struggling in terms of the economic and growth outlook, and that is unfortunately in a contractionary phase. And the data that's coming out of China, as I said, is worse than market estimates. But across the board, the Australian economy, the Australian data side of it, is relatively flat, sort of broadly in line. It's really reflective of our view that the economy is being able to sort of move forward, but clearly there are some headwinds, particularly when you look at the challenges around energy prices, rent, insurance, food, etc. Those challenges that are coming through are constraining, obviously, the discretionary and consumption side. And we saw that most recently in the second quarter GDP figures, which really point to quite a material slowdown in the domestic economy. Just looking at sort of personal consumption, it was up roughly around about 0.1 of 1%, but that's 3% lower than the fourth quarter's figures in 2021. And a lot of the growth that we saw in terms of the GDP numbers that came through in the second quarter, again, were really driven by an increase in migration, as opposed to per capita spending actually increasing over the quarter. So it does really show that the moves by the RBA are starting to have an impact in terms of the growth outlook. And as I said, from our point of view, inflationary pressures are still higher than where the RBA would like. We think potentially there's probably a 0.15% increase in the cash rate. That would take our local cash rate to 4.25%, and that's where we'd sort of see the RBA really starting to sit on their hands for an elongated period through the back end of this year into 2024. But then when you look at sort of the other major regions, Europe and Japan, notably we are starting to see some reasonable signs of recovery, particularly in Europe. And certainly that's been reflected in the UK jobs market as an example, but also Europe more broadly, despite clearly there are numerous challenges continuing to face into Europe around the energy outlook, as well as obviously the challenges that really facing the doorstep in regards to the war in Ukraine. But the growth in Japan is a positive sign, in our view, also for global economic activity, third largest economy in the world. It is offsetting some of the challenges that we're seeing in China, despite the moves by both the PBOC and the government to try and stimulate growth. But notwithstanding that, when we think about sort of the global macro environment, it is a little bit ad hoc across individual regions. But by and large, we are starting to see, as I said, some stability in the growth outlook. And our view around sort of where cash rates are going to land through the back end of this year, we think that the market environment continues to point to an upward trajectory of growth through 2024 particularly. And as I said, when we're thinking about our portfolio positioning, months that we've seen in August actually, from our perspective, allow us to be able to reposition portfolios and again start to add a little bit more risk where we think it's appropriate. And on the bond side, as I said, as we've spoken about previously, add to our duration with the view that, as I said, with interest rates starting to peak, yields will probably start to move lower over the course of time. So again, we think that'll be positive for fixed income markets as well. So again, another interesting month, another challenging month. Really important about maintaining a flexible asset allocation approach, again, is what we've spoken about previously. And always trying to focus, as I said, on how we can better manage risk and articulate the opportunities as the markets present themselves. As always, if you have any queries about the portfolios, please feel free to reach out to anyone in the team, and we'll catch up again next month. Thanks and bye for now.